Anyone working in financial services, especially in the major offshore centres, will be all too aware of FATCA and its requirements, having completed their first reporting on US persons in mid-2015. Service providers in the Crown Dependencies, Bermuda, Cayman and BVI will also be familiar with the requirement of their automatic exchange agreements with the UK, the so-called CDOT. They will be preparing for that additional reporting in mid-2016. Now, most practitioners are aware that the OECD's Common Reporting Standard is coming down the line. They may not appreciate two important things. Firstly, for over 50 countries, it starts on the 1st of January 2016. Another 40 countries are implementing the Common Reporting Standard in 2017 and 2018. And secondly, and possibly more importantly, the Common Reporting Standard, or CRS, is much more than FATCA times 92. There are actually a number of material differences that demand a separate implementation program. Now, CRS was based on the basic principles behind the various intergovernmental agreements the US signed to give effect to FATCA, so it shares many common features. The basic concept of financial institutions is a part of CRS, and the mechanism of these financial institutions reporting information on the holders of financial accounts to their local tax authorities is at the heart of CRS. So on the face of it, CRS looks very much like FATCA. However, there are a number of differences between the two models that mean implementing CRS is a much greater challenge than many businesses realise. When the intergovernmental agreements were enacted by jurisdictions, there was no central guidance issued about its practical implementation. We just had the agreement itself, and it was down to governments to provide guidance on how that agreement was to be interpreted by local businesses. That is not the case with CRS. When the OECD published the CRS, they also published 300 pages of guidance. They've subsequently published a further 100 pages on practical implementation. This means there is far less flexibility to adapt to CRS to local law and practice than there was with FATCA. In a number of instances, this actually creates conflicts with FATCA guidance. So for example, FATCA doesn't require financial institutions to either review or to report accounts where the value is less than $50,000. No such exemption exists in CRS, so the reportable population is that much larger. The definition of an investment entity is different. Most companies that are administered by a corporate services provider can be treated as an investment entity under FATCA. This could make reporting much more straightforward, especially for counterparties to those companies. Now, the definition of investment entity under CRS requires a greater level of management by a service provider. This means many entities will have different classifications under FATCA and CRS, and that's likely to cause some practical problems. FATCA has an exclusion from reporting for certain listed shares. No such exclusion exists in CRS, so this will cause difficulties for many listed funds. And also, FATCA had a number of non-reporting financial institutions. Whilst the concept exists in CRS, the scope is much more limited, so many more institutions will be required to report than under FATCA. And finally, the consequence of this multi-jurisdictional reporting needs to be considered. So to give a simple example, when a Guernsey bank maintains an account for a BVI company that has a Finnish owner, reports are required to both BVI and Finland. So as 2015 draws to a close, the challenges presented to businesses in 2016 should not be underestimated. They will need to complete full reporting under US FATCA. Those in the UK, in the Crown Dependencies and the overseas territories will need to handle the reporting under the UK CDOT agreements, and all businesses will need to prepare for CRS. At KPMG, using our experience from FATCA implementation, we're ideally placed to help businesses navigate those challenges. We have experienced teams in all the offshore centres and are always happy to assist businesses understand the different requirements and to design effective implementation programs.